All right, welcome to the Mentis podcast. Today we have Angie Aki with Ohana Investments. I appreciate you jumping on today.
Yeah, thanks for having me, Nick. I appreciate being here.
So you're focused in real estate syndications throughout the Southeast, and today I definitely want to get a little bit of your insider information on what is happening in the Southeast. Clearly, it's boomed over the past few years, but it's really been a safe harbor for investments for a long time. But where's next? I know that like Miami, really had an insurgence of money from COVID, but then they also had a lot of those like stimulus checks getting spent down there. So maybe that's going to start retreating. Is there a market down there that's really got your attention? And what's next for the Southeast, whether it be Florida, Texas, South Carolina, or any of the other states?
Man, that's a really broad but great question. So the short answer is I don't really know, right? I don't think anyone knows because unfortunately we don't have a crystal ball. I wish that we did. But I'm very bullish on the Southeast. When you look at the migration patterns and you can look at the employers flooding and the people flooding. I mean, heck, I feel like we can't keep them out of Florida or the Southeast. So people are pouring into our states by massive numbers. I know I'm sitting in Orlando right now, and we have a vast increase in population. So literally, I feel like you can drive down the road and you see multifamily developments left and right. And I know you mentioned development as well. So Orlando is a really hot market. Although I will say, there's pros and cons about being in a hot market. It's really difficult to find deals that pencil out because people want top dollar for their assets. So Jacksonville is a great market. And last year I worked on an asset there. And so we're managing that currently. It's a 2-asset portfolio in Jacksonville. We did have a couple offerings in South Carolina. South Carolina is a really great market as well, overall, as well as North Carolina. So I had a couple offerings in both of those states. So where is next? I don't really know. It's almost like if you take the metro centers and go out a little bit and further, I don't want to say suburbia, but I know if you know where Orlando is and you know where Tampa is, there's a county in the middle called Polk County. Polk is a really great place to invest right now. And that's where I personally own a small mobile home park with a partner. And so we're also building some affordable housing there as well. That's a great market. The Southeast overall, I don't want to say you can't go wrong because we were just talking about something earlier, right? Talking about evictions and some of the laws there and some of the timelines. But Jacksonville's great. Central Florida is great. South and North Carolina. I have not personally done any deals yet in Georgia. So I've heard varying things now. So I've heard good and bad. And I've not done anything in Alabama yet either, although I did have a colleague of mine and they're doing some build to rent there. And I know build to rent, we had a build to rent offering in North Carolina last year, just outside of Boone. So that was a good area.
Well, I appreciate you kind of diving into that. The one really piece that stuck out to me there was the county between Orlando and Tampa. And, I've heard multiple people say that that's just like Orlando and Tampa are going to like become two, they're just going to like merge and it's going to be one big city the entire way. And that entire, all the way over to Clearwater, up and down, that entire metropolitan area is just going to continue to just boom and attract a lot of investor dollars. And, it's a vacation hub. I think Orlando has benefited extremely well from obviously tourism, but Tampa becomes more and more popular as maybe people are getting priced out of Miami and Fort Lauderdale. I think that it's definitely a market to continue to watch on. I've even considered starting an office down there as well. It's definitely something to maybe keep an eye on, and we'll have to check in with you down the road to see if that, if there's anything else that comes up. As far as, the density of some of these investments, I know that, kind of governments are really leaning towards more dense, I guess, more affordable units. They don't want the urban sprawl as much. Is there anything you're seeing in Florida right now for regulations on that, or is everything kind of still on the table?
Yeah, so Orange County, which is where Orlando is sitting, they're looking at increasing density. And it's really interesting. So that got pushed back at a recent meeting to discuss that further. But it's interesting as a resident here, right? So when you look at it one side as an investor and the other side as a resident, it's, I feel like I'm pulled in both directions, but they are looking at increasing density. Some of the other things I know recently, they were looking at, capping rents or how much you can increase the rent year over year, right? So I think, right, there's a severe housing shortage is the reality. So the counties and the zoning departments are now saying, okay, how do we accommodate all those people, right? How do we want development, we want investors to come in, but we also want it to be, we want it to be fair for the renter too, right? So they're kind of towing the line and straddling the fence. And quite frankly, I think it's really difficult for counties at this point. But when you're looking at potential rate caps and you're looking at, yet increased density, it's like, what the heck? And I talked to one guy that I collaborated with or connected with, and he is building build to rents, and he will not build in Orange County, which is where Orlando is. So he looks like county by county. And I hate to say this, right? So no matter what your political view is, a lot of people and a lot of investors will say, okay, is that a red county or a blue county? Because a lot of the laws and jurisdictions and zonings will go one way or another. And, when you look at the way, I was just reading something earlier this morning in the New York Times, when you look at the population, you look at where people are moving, a lot of the country is moving from blue to red states as far as either personally or as an investment. And then you have the other side of the coin, right? Where people are like, oh, I'm not living or investing in a blue state, or excuse me, a red state. So there's so much that goes into it behind the scenes. So yeah, we're seeing quite a bit of politics around that for sure.
Well, that's one thing that people maybe don't talk about enough in real estate, and that's it. Each jurisdiction, and that is county by county, not just on a state level, really is impacted by the people who are running that local government. It doesn't matter if it's Republican or Democrat. I've seen terrible ideas from both sides, but they go in, and if they're maybe don't have any skin in the game, or maybe don't understand how some of their decisions impact whether or not investment will continue to come into their markets, it really can impact what we're doing when we're trying to do pro formas for a long period of time. And that's why I think it's really important to have a lot of understanding of where you're investing, know who's there, make sure that they're, kind of sound and steady, built on principles of, kind of letting people run their businesses the way that the free market was designed.
Mm-hmm.
I mean, if you start capping rents, all of a sudden you're kind of getting into that tiptoeing around rent control, and you turn into a city like DC, where we have a deal that we're working on right now, and it can take a year to purchase a property in DC and a year to sell a property in DC, just because of all the regulations and red tape and the bureaucracy, and then attorneys are getting crazy fees, and unwinding it is just almost impossible. But the other side of it is, you had kind of alluded to it before, we have some properties in Georgia, and the eviction laws have been horrendous since the pandemic. So we have some properties that people have literally not been kicked out for months and months, pushing on a year, and they're really just backed up. And the policies behind that are horrible. And when you see other places that are actually keeping kind of the rule of law in place, so I think it's really fascinating that you mentioned like density and what are the rental policies of the area. Those are all really important for long-term investors to be aware of, and I appreciate you kind of bringing that to our attention.
Yeah, and you have to know, and if you don't, right, as an investor, because we work with a lot of passive investors, right? So it can feel really overwhelming to know. You don't have to know the answers, but it's great to ask the sponsor team, and they should know the answers, right?
Correct.
So
Correct.
that's why you don't have to know everything, but you have to know people that know that information, right? So you should be able to lean on the sponsor team, the general partners, or the fund managers and say, hey, what are we looking at from a political standpoint or a zoning or jurisdiction standpoint? I didn't know until we spoke earlier, Nick, that in Decatur, right, and outside of Atlanta, there are some eviction problems still going on, right? And we're sitting at this recording, we're in 2023, where I know, unfortunately, in our mobile home park, we've had to do a couple evictions and people weren't paying, and we've been able to get those tenants out, do any necessary renovations, and getting paying tenants in. And without that, I mean, it's a small mobile home park. So it's not, I mean, we're not talking about thousands of units or even hundreds of units. Without the capability to do that, we're dead in the water. What are you going to do? And that's, that can cripple the business plan for the asset. And that's exactly what it is. When you're investing into a syndication, you're in essence investing into a business. So that can kill the business plan. It's all really important things to know.
Which, is why we do the syndication route. And that's, the investors don't need to know every last thing, because they shouldn't be expected to sit and do real estate 24/7. If they were, they would be doing the syndication. We're providing that expertise, and we do the best we can with the knowledge that we have before we go into an asset. And Atlanta, even though it still has eviction issues, has a lot of positive things going for it with the population growth, and the jobs are pouring in and the businesses are moving there. It just has one of these really kind of sticky points right now, which would make us hesitant on adding additional assets. But working through it, you just have to do the best you can. And that's, again, why we do syndications, so that we can diversify between multiple different assets. That way, if one is sucking wind, the other one's carrying us, and we're able to kind of push through. And it just gives us that diversification, and kind of making sure that regardless of what's happening, we do with everything within our control to the best of our abilities, drive the value up with the kind of the forced appreciation through renovation, and operate them the best we can. And I've never had a property where you just stick through the hard times. And on the other side, I've never had a property where you do the fundamentals right, that you don't get rewarded on the other side. It just seems that if you do business the right way over a long period of time, it always has a way of working itself out, even in these more uncertain times that we're in now. And you're, a fundraiser, and you definitely are out talking to people about investing capital. These times are crazy. Inflation, interest rates, and we've had COVID and all this uncertainty, and people are pulling back, unsure about what to do. What's your message to the folks who are unsure about where they're supposed to be investing today, and what should they be doing? Because some people are a little afraid that we might be going through 2008 all over again, and they don't want to lose it all.
Yeah. So in my opinion, we're not going to go through 2008 again. I think when you look at the economy as a whole, I don't foresee that happening again. No crystal ball, right? But there is hesitancy, and I think people are right to be hesitant. But that hesitancy, in my opinion, should equate to making sure that the offering is conservatively underwritten, right? So asking about underwriting, asking about those important things. When you look at debt service, that can make or break you, right? Is there a floating rate? Is there a debt cap, right? Or a rate cap, excuse me. A rate cap, is that for the whole term of the loan? Can you extend it? So knowing these questions, I think people are right to be conservative, but it's like anything, right? You can look at any market and say, all right, I just kind of want to sit out and wait and see how this shakes out. But then my question to investors is, how long are you going to sit out of the game, right? If people, been talking about maybe sitting out, or maybe they're sitting out for a year or two, like at what point do you have a clearly defined metric where you say, okay, now I'm comfortable investing? And in any market, you can find opportunity in any market. So I think it's just really the way you look at things. I am all for, and I tell the investors that I work with, I think that now, like I'm still investing. Personally, I had a call with someone earlier, and I'm investing in a portfolio that is affordable housing, multifamily in Texas. And so it's right for me, right? So I'm personally still investing in this market. I'm talking to investors and they're investing in this market. I think a little more conservative at this point, making sure they're covered and making sure, what is the exit plan? Is there a bridge loan? Is there is it a fixed rate, right? What is the prepayment penalty? So just understanding the nuances a little bit can help make you feel more comfortable. If you're looking at a value add and multifamily, and you're going to get to pro forma if you're able to push the rents by, $500 or whatever it is. If when we're seeing rent increases slow down or even drop some, if that's your entire business plan, you have the potential to be in trouble, right? So you have to understand the whole business plan. I think you have to do a little bit more due diligence, but I think there are still really good deals and offerings out there. They just may be a little more difficult to come by.
I think you're right to say that it's more difficult right now to get anything to pencil. The Federal Reserve is putting downward pressure on the economy, and in particular, commercial real estate feels it very early on because we're so interest rate sensitive to purchasing and selling our assets. I think that all the points you made are like the investors. I think it's important for them to have a good understanding of what's going on, but it might not be their, I don't, or at least in my opinion, I don't find it to be their responsibility to be experts on how does the debt service coverage impact the IRR and all of those things. That's where it comes down to making sure that you're investing with somebody who has skin in the game, who's signing their name to the loan, who knows where they're investing, and it comes back again to the basics that we were talking about before. It should not be a risky investment. Multifamily should not be something that you are getting into and risking it all. At a minimum, I think you should be getting your capital back at a minimum. I mean, and that should be an operator who's got the ability to tell you what's going on and able, has the wherewithal to get through the hard times. So, it's not a time to sit, I think, on the sideline if you're trying to continue to grow your money. I think it's time to find the people that you want to work with and the markets that you want to invest in. And then over, I guess over this year or next year, make those bets, because on the other side, remember, the economy will be better and you don't want to miss that upswing. You can never really time the market, as they say. And I think just really making sure that your investment is a fundamentally sound one is always a good idea for regardless, at what stage you're at, in your investing.
And you don't have to know everything, right? So as Nick said, you don't have to understand how DSCR is impacting IRR. You don't, but you probably want to have a basic understanding of debt service and why you may want to understand if it's a bridge loan or fixed or variable and what that may mean to the asset. But that can be something as simple as saying, hey, Nick, can you explain the debt service to me? What are the pros and cons of the way this is structured on this deal? Right. So it's just knowing to ask that question and understanding. And as Nick mentioned, trusting the people you work with. And that is so important. I've been in sales for over 20 years, right? So work with people you know, like, and trust. And at the end of the day, I always tell people, I'm like, you have to feel comfortable with the investment you're making. It has to meet your investment criteria. And if you haven't taken the time to pencil out and know exactly what your investment criteria is, then frankly, you're doing yourself a disservice, because you want to know what that is. So if Nick or I roll out an offering, you're like, oh yes, this meets my criteria, I'm ready to go. I just need to do a little due diligence, ask some questions. But it's got to feel right for you. It has to be the right investment for you. And there's no right across the board or wrong. But knowing what your criteria is and pulling the trigger when you have something that meets that criteria is really important too. So you don't want to get stuck in analysis paralysis. I talked to an investor the other day. She's like, I just need to understand all the ins and outs. I'm like, okay, I get that. And I respect that. You're not going to understand all the ins and outs unless you become an operator. So if that's something that you want to do, that's great. Then you should do that. But there's other things that you should focus on to get to that point. If you're looking at coming in as a limited partner or an LP, there are things that you need to understand, but you don't have to understand all the nitty gritty and be neck deep. Because in essence, that's a benefit of investing in a syndication as an LP. You're not neck deep. You're sitting there with a cocktail or mocktail in your hands and your feet up on the beach or doing whatever it is you'd like to do. That's the benefit.
The same thing, with all of your other investments. I know people invest their IRAs and 401ks in the stock market or mutual funds. That when they're going through that, I find a lot of people still don't know a lot of the details about where they're investing that money. And I think in real estate, we provide a whole lot more transparency, and we give a lot more benefit because you get the depreciation benefits from the properties as well. And I think that, you're not supposed to be the operator, just like you said. And that's where it comes down to making sure you trust them. They're putting their own skin in the game. We always invest our money alongside our investors. We're feeling the pain if it comes along. Are we perfect? Absolutely not. Anybody who says they've never made a bad investment has not been in it long enough or is not telling you the truth. There's just no way to know everything. But as long as we go back to the fundamentals, it's so boring. But as long as we do a good job making sure that we underwrite properties, we're going to win more than we lose. And we'll get through, kind of any type of downturns that come our way. Just because we're, going to continue to do the honest and right thing over and over and over again. And that way we can get through those, kind of hurdles that we're all facing today.
Yeah. And that's a really great point. If you're investing in the stock market, you're investing in Nike. I'm not picking on Nike. Nike's great, I guess. I don't know. But if you're investing in Nike or a large company, you don't know, you're not looking at the P&L statement. You don't even have access to their C-suite. In a syndication, in essence, the GPs or the general partners are the C-suite. They're the CEOs in essence. They're the CFOs, they're the COOs. So if you think of it like that, you do have a lot more one-on-one connection. You have a better understanding of what's going on than if you are investing in the stock market, because at that point, you don't know the ins and outs. You don't know what the business plan is. I mean, if you're in the market, do you really know the company's business plan? I mean, maybe some people do, most don't. And that's why recently I did an article and did an interview too with a self-directed retirement account. Sorry, a self-directed retirement account or IRA company. Because if you don't have a self-directed retirement account, I highly recommend you look into it. Because I know for me, I have some money in the stock market. I'm not a stock market lover. I love real estate. So I want to self-direct my retirement funds, which means I'm able to invest, the syndication I just mentioned in Texas for affordable housing, that will come out of my self-directed 401k. So I know where that money is going. I know the business plan and I feel really comfortable with that. That's the benefit of self-directed retirement accounts.
Yeah, there's no doubt that there's a benefit to knowing who you're working with and making sure that, like they're doing things that they're aligning with your, I guess their incentives are aligned with your better interest. I mean, we don't make a ton of money until we actually perform and do the asset justice and get through it on the other side. And we can make good money for doing that. And that's why we're incentivized to work year over year while we're holding them to make sure that we're kind of protecting all the money that's been invested. But yeah, I think, with all of the, the noise out there, and sometimes it's difficult to decide whether you should invest in this market or that. Sometimes, it just comes back to, finding the right people to work with and just pulling the trigger. And you're in the marketing space, or you were in the marketing space for a long time. And, you have a really unique name to your company. Could you maybe give us an idea? Why did you pick, your positioning in the market and the background behind your name?
Yeah, I'd be happy to. So Ohana Investment Partners came out of kind of two thoughts. So my husband's side of the family, his dad is half Hawaiian, half Chinese. So he is of Hawaiian descendant. So that just that stuck with me. And Ohana means family. I am a big community person, and it may sound hokey if you are listening to this or watching this, but I am a firm believer that we can do so much more in the world if we do it together as a community, and we can lift each other up. So through passive investing, my goal is to positively impact families, which should positively impact communities, right? Which can positively impact the world. I believe in the ripple effect. I love community and family, and we can do so much more together. And when you look at syndications, we are investing as a community, we are investing as a family, and we really are making a difference in the communities that we are serving. And yeah, we should all function as a family. And then if you think too of Ohana and the beach and Hawaii, so everything, that is everything about passive investing to me. If I mentally picture it, it is vacationing or relaxing or retiring and letting someone else do all the work and getting the benefits of it. It just really boils it down to me. So
Makes a lot of sense to me.
Yeah.
Thanks for sharing.
of course.
If people are interested in learning more about your company and kind of the direction you guys are investing in, where could they find you and reach out?
So the easiest way is to, and if you're listening to this, hopefully you will just remember this, ohanainvestmentpartners.com. My website is the best way, or you can email me at Angie@ohanainvestmentpartners.com. If you go to the website, you can sign up to become an interested investor. I also host investor and women networking events as well, both virtually and in person. So no matter where you are, I have that as well. But yeah, please connect. And the more people you connect with, right, the more opportunity you're going to have to invest, which is amazing.
Yeah, the collaboration in the real estate space, I think it's more than most industries, honestly. I think I have not found, we all compete, I guess, with each other, but most of our competitors, are more than willing to like help. And I think it's kind of a rising tide lifts all ships type of thing. So certainly feel free to reach out to Angie and any other operator out there that's in the syndication space. Most people will probably be very helpful with their, I guess they'll be generous with their time in most cases. So
Absolutely. It's the law of abundance, right? So, and we all do help each other out. We partner on deals. And I tell people all the time, I'm like, Nick and I may work together on an offering and we may not work together on some. So the more people you have in your network, my network is probably one of my greatest assets. So the more people you have in your network, the more you're going to learn, the more you're going to benefit, and hopefully the more you can give to others as well.
Well, I appreciate you coming on, and we'll stay in touch. Best of luck with 2023 and, kind of getting through all of these obstacles that we're going through. We'll catch up with you soon.
All right. Thanks so much, Nick.
Thank you.